Welcome to It's No Secret, a podcast for those who want their money questions answered.
Join us as we talk to real Kiwis and share truths about our own financial lives, because the truth is, there is no secret to achieving financial freedom. Lovely listeners, welcome back to another episode of It's No Secret. Today we are chatting about how to actually calculate how much insurance you need and really just dive deep into the world of personal insurance, because there's some grim stats we're going to start with. And I guess this is somewhat of a continuation of our inadvertent recent topic of the show that's been talking about things like what happens when you die with your investments, thinking about estate planning and financial breakups, just on the doom and gloom topics. We're here to talk about insurance and the stuff that you don't actually necessarily like paying for, but you should kind of be interested in, and also figuring out like, what do you actually need to know if you're not going to go through a financial advisor, and how can you potentially do this yourself? Because not everybody needs to go through an advisor, although Christine has, and we can hear about that experience. But to kind of kick us off and to, I guess, maybe shock some people into action, let's run through some research. So 98% of homeowners in New Zealand have their home insured, surprise, surprise, and 95% of car owners have their car insured, but just 20% of New Zealanders have themselves insured against sickness or disability, which is not fantastic. No, we don't like thinking about death, do we, Christine?
No, literally the research says that we do not like thinking or talking about death.
Wow, what a surprise.
There is data to back that up.
Exactly. What else do we know about insurance though? What else is kind of shocking us?
So the latest FSC data, that's the financial, oh my God, what is it? That's the
Financial
Services Council data shows that New Zealand life insurance industry supports around 4.1 million insurance policies that include trauma, disability and income insurances, despite only 20% of New Zealanders having themselves insured.
Yep.
So it is like a decent amount, but still it's not a lot relative to the bulk of us.
Yep.
And generally speaking, we just aren't really that insured and don't want to be.
No.
Yeah. Or don't want to pay for it, maybe.
But we kind of should be, right? And perhaps it's not as hard to get personal insurance as you think it is. And I think also maybe like people have just not been well taught or understood the reasons for personal insurance, and I guess the scenarios that play out and how this could be beneficial or impactful in your life. Interestingly, last year, New Zealanders were paid over $1.2 billion in claims. Yeah. So it is also one of those things that sometimes I think people assume that like, I'm going to have life insurance, I'm going to have trauma insurance, and it'll never be paid out, and I'll pay for it for 40 years and I'll never reap the rewards. But the reality is like they do pay out because there's also very high risk and some pretty grim stats around the likelihood that things happen to you over certain periods of your time. So just jumping down to some really fun stuff that we found through Pinnacle Life, because in order to prep for this episode, Christine and I were working through some calculators of sorts just to see what's out there on the interwebs as like, okay, well, what's actually going to help the people to figure out what they need for insurance and calculate that. And we will dive into some of those resources soon. But as I was going through a really nifty calculator on Pinnacle, I was hit with these lovely reminder statistics. So there is a 1 in 6 chance that one person in a couple aged 30 will die before retirement being 65, so dying pre-65. There is a 1 in 10 chance that couples aged 30 will have one person permanently disabled before age 65.
Yeah.
That's not insignificant. Yeah. There is a 1 in 4 chance that either of you or your partner will have a major trauma event in your lifetime. Major trauma events being typically things like cancer, heart disease, stroke. 25% chance. And there is also about a 25% chance that all couples have a period of 3 months or more where one person can't work due to sickness or disability. Yep. So we go through many periods in our life where potentially one of us needs to have a sustained period of time off work. But then outside of that, there are also relatively high likelihoods that you're going to be faced with a major event, either you or your partner passing away before retirement age, you or your partner being permanently disabled before retirement age, or you or your partner having a major trauma health event throughout your whole life. And that is the highest probability, being 1 in 4, which we will also talk about because it leads into why trauma can be some of the most expensive insurance cover.
Great.
Yeah. But I guess before we start maybe like digging into all of the details, I wanted to run through some terms and some definitions because we're going to throw out a bit of jargon because unfortunately with anything financial, there is jargon involved and there's quite unique jargon to the insurance world, which I'm assuming, Christine, was kind of news to you until you went through the like personal insurance process.
Yeah, definitely. I mean, even now looking back at my policy, I'm like, oh, what does that mean again?
What have I signed up to here? What is this?
I think it's just really easy to forget what it all means and all together.
Yes.
So, and like you understand it in the moment when someone's like communicating it to you. But actually being like, oh, a waiting period is this.
Yeah,
you know?
Exactly. So under the personal insurance kind of bracket, there are 4 main types of insurance that you could get in New Zealand or elsewhere. They are income protection. So income protection pays you a monthly amount if you're unable to work due to illness or injury. There is trauma cover, otherwise called critical care cover, and that provides you with a lump sum payment if you were diagnosed with one of a set of specific conditions. So that's the stuff typically covered. Well, trauma events are typically categorized broadly into 4 major things, but there might be kind of sub-conditions under those 4 major things. So the primary ones that get paid out are cancer diagnoses. And of varying spectrums. Like I have known people that have had their trauma cover paid out for a skin cancer that's not actually been life-threatening, but has been serious enough that has met the definition for them to receive their trauma cover payout. It could be something as serious as like terminal brain cancer. It could also be stroke. It could be heart attack. Oh, I don't know what the 4th one is, the 4th kind of category, but they're the 4 I'm like, what's the other major health event that you'd have in your life?
So what did you say?
Stroke, heart attack, cancer. Oh, I think it's like loss of limb.
Oh, okay.
Yeah, I think that's the other one. Like basically you have an injury where like you lose an arm or that type of thing. Like you have a significant injury that prevents you from doing stuff and you need to have like
supplement income or something.
And rehab, basically. Like you need to go through some treatment. So that's trauma cover. Life cover is insurance that provides for people that you leave behind. Pretty obvious. It pays out when you die, and it pays out a lump sum of money to essentially who is like named as the policy owner. That might be your estate or it might be a specific individual. And then the last one is TPD, which is total and permanent disability, sometimes also just called disability cover. And this is also a lump sum payment. So there's 3 that are lump sums: trauma, life, and TPD. Disability cover is a lump sum that is paid to you if you're deemed permanently unable to work and meet a certain definition. So essentially, like trauma has a much lower threshold to payment because it's just a health event. And, you know, lots of people could have a heart attack or a cancer diagnosis and then work through that and be able to return to work. Whereas total and permanent disability is something that has happened to you that you subsequently receive sign-off from 2 separate medical professionals, essentially saying you can never return to work in the capacity that you otherwise were.
Right.
Yeah. So fairly significantly life-changing, a lot involved in, I guess, the considerations around how much insurance you would want for that. And that's why I think, well, we wanted to kind of talk about this because it's like those 3 different lump sums need to cover different scenarios and different expenses, and how do you like figure that out? Income protection in some ways is like, well, how much money are you earning and do you want to replace that income? And then working through those maths. So do you want to explain waiting period and benefit period to us?
No.
Chrissy, you have income protection.
I assume, okay, so the waiting period is that how long you have to wait before the policy kicks in. There's usually like a kind of a stand down period.
So you've had the event, you have to wait a certain period of time. You basically can't be off work for one day and then the next day get paid out. No, there's usually a stand down period to essentially make sure that there's validity to the claim and that it's like real. kind of thing, and that it's a serious, like, longer term impact. So that's what the waiting period is. And you can choose the waiting period. So there are standard waiting periods that could be like 4 weeks, 12 weeks, some could be 6 months, some could be a year, some could be 2 years. And you would assume that the longer that your waiting period is, the cheaper the policy will be, because the longer the waiting period is, the insurance company is betting on the fact that you will get better during that period of time, and therefore they won't have to pay out. Whereas the most expensive insurance premiums for income protection are those that have a 4-week waiting period. That's typically the minimum, 4 weeks, 30 days. And if you're not better in 30 days, they start paying out.
Yeah, right.
You're going to pay for that privilege, obviously.
Yeah.
What about the benefit?
I'm just like, what is mine?
Do you know what yours is?
No, I'm going to look it up.
Great.
Right now.
I know what mine is, so we can talk through that. That's good. What about the benefit period?
Is that the amount of length that you're covered for if it's income protection?
Yes. So that is, you can think of like the benefit period is the period of time that you will receive the benefit if it's being paid out to you. Now, again, this can vary based on your needs and your job and the policy that you're with, but standard benefit periods are up until retirement age. So let's say, argument's sake, it's pretty standard to get to age 65 because essentially the assumption is that it's paying you for the period of your working life. And then at that point you would have a retirement plan, which is a whole other conversation we won't get into.
Stay tuned for the next episode.
So benefit period to age 65 is fairly standard. Alternatively, you can sometimes just have a fixed number of years benefit period. So you might have a 5-year benefit period or a 10-year benefit period. But that basically just means that the minute you start being paid out, that clock starts ticking, and then after 5 years, you would stop being paid.
Makes sense.
Regardless of whether or not you've returned to work, essentially.
Okay.
One thing also to note with income protection is, if you do return to work, you're going to stop being paid. If you're able to go back to work, and that's really the, I guess, desired outcome for everybody is that you're not
go back,
permanently on income protection. But there is that. There's 2 other kind of pieces of jargon that I wanted to talk about. One is sum insured. So the term sum insured basically just refers to the amount that you are insured for in any category. So if you were talking to your insurance provider and you were like, how much life cover do you have? They would say your sum insured is this. And that's the dollar amount that if you were to pass away would be paid out on your behalf. Same thing, sum insured for disability cover, sum insured for trauma cover. It's essentially the dollar amount that would be paid out. The other one then is thinking about premiums. So premiums are, I feel like everyone's familiar with premiums because it's universal with like cars and houses. But basically that's just the cost and amount that you're paying for the policy. Different to say property or car insurance, you have the choice of 2 types of premiums when it comes to personal insurance. Do you know what type of premium you have on your policy?
I think I have stepped.
Okay, great. Well, that's a good start. Do you know what is the difference between a stepped premium and a level premium?
A levels, it's like fixed and floating kind of, in the sense that level is fixed and stepped is floating. So it's reviewed annually.
Yep, perfect. So it increases annually. Like stepped is guaranteed to increase annually. A level premium is generally only increasing by CPI. It's not increasing on other factors. Now, the reason that that's important is because if you think about it from the insurance company's point of view, as you age, you become a higher risk and likelihood of claim, right? You're becoming like increasingly going through the probability stage that you're going to claim. So when you go and get, say, a disability cover taken out when you're 25, your likelihood of having a like total and permanent disability event is statistically much lower at that age than it is at 45. So on a stepped premium, the amount that you'd be paying for that insurance policy at 25 should be lower than what you're paying at 45. Now, that can become really challenging when it's stepped because those increments are based on your age factors. And what can tend to happen is people start to cancel or look to cancel their insurances at the time where they're statistically most likely to claim on that insurance because that's when it's the most expensive. And that's why it's most expensive, because you're higher risk. So another way that I guess insurance companies have come at an alternate solution to this is to offer what's called a level premium. So a level premium is basically an amount that, generally speaking, stays the same throughout the life of the policy, with potentially some slight adjustments for CPI, but not the big incremental steps. But what it means is that you at age 25 are going to be paying higher than your mate who's on a stepped premium at age 25, because you're locking in your premium at a higher level. Now, important to note, when you are getting a quote for any type of insurance and you're considering the cost, you can run, or the insurance provider can run, a projection on the level premium and the stepped premium, because dependent on your personal risk factors, there will be a break-even point as to when level is of benefit and will overall be cheaper for you than just opting for stepped. But that really depends on the age in which you're taking out the premium in the first place, or the policy in the first place. Also, like things like, what's your role? Are you a smoker? Do you have other health factors or health loadings because of your personal medical history? And do you intend to keep this cover for a really long period of time? And why I say that is because when we were looking at this, when I was back like an advisor, let's say we have, you in your mid-20s come to us and you're like, I'm looking at this cover and it's income protection, and you're like, I want to be able to secure my income for many years to come, 25 years, like at least until I'm 50, and then we'll kind of reassess based on my financial situation. And we look at that and we're like, okay, the payback period for where level ultimately starts to become cheaper cumulatively for the total amount you pay is at year 15. So we would have the chat to you, hey, Christine, can you afford right now for the next 15 years this higher premium, knowing that from year 15 to year 25, you're going to be significantly better off, and overall you will like pay less, but you're paying less on the basis that you've held that policy for that total period of time. So it's really a conversation of where are you at and where's that payback period, because someone that comes to us and is 40, their level premium will probably be exponentially more expensive, and there will never be a natural payback period, because at that point in time, they're already in the highest risk age category if they're like a male, a smoker, all that kind of stuff.
Right. This is making me think I need to change my policy.
I mean, not necessarily. There may be, but I think that's probably the key thing, right? Because I think oftentimes people, understanding the differences in the premiums is important, and really getting across that jargon is important, because if you're just presented with a level premium versus stepped premium and it's not explained to you, you're going to pick the stepped every day of the week because it's cheaper. And unless someone can kind of identify when it's appropriate to have a different premium type, it's really hard to determine that yourself. So as an example, like I personally have all the covers. We talked about this before. I've got income protection, trauma cover, life cover, and total and permanent disability. My trauma cover is on a level premium. I got that when I was just looking at this the other day. It went into force in 2016. What are we in now? 2024. That was 8 years ago. How old was I? I'm trying to remember math. Like 26.
25. Oh, yeah.
26, right? So for me to get insurance at 26 for trauma events like stroke and heart attack that I'm not in a statistically significant age group to experience at that point in time, and lock in a level premium was a pretty good choice. Also knowing that like that's an insurance cover that I probably want to hold until I'm 50. Or to a place where we have the financial freedom to genuinely cover like a big medical event like a stroke.
What's the statistically significant age bracket?
It's typically when you get like 40 plus.
Oh my God. Okay.
Yeah.
So I've got time.
You definitely have time. The general consensus is if you're able to lock in personal insurances under age 30 and you have a pretty clear medical record, i.e. you've not had any major surgeries in the past, you've not had any major injuries, you're not going to get what's called exclusions. If you have had a major surgery, I'll use my brother as an example. He had major lung surgery from like severe pneumonia that he got overseas. Because of that, even though that was for no fault of his own, he's probably going to have some like insurance exclusions around things to do with his lung because that's just what happened, right?
Yeah.
And so if you think about then throughout the course of your lifetime, you're more likely to encounter medical situations the older you get.
Yeah.
And so if you can like pop out of school and get insurance at 19,
great.
Yes. Go and do that. People don't do that because they don't know about it. But like that's the time in which you probably have a pretty clear medical history and medical record and you're very fit and you can pass the medical assessments and like lock in some pretty decent insurance. Now, do you need life cover at age 19? Probably not. And we can talk about that.
Yeah.
But do you need trauma cover? Maybe. You know, are your parents going to be able to fund you if you have a stroke or if you get diagnosed with cancer and you need like private cover?
Yeah.
Maybe not. And even if you're not worried about having that event at age 19, but you are wanting to kind of future-proof your like further on finances, it could be worthwhile locking in a policy really early to get a great premium that you know is going to benefit you like during your working career.
Yeah, for sure. If I am a listener and I'm like, yep, I'm over 30 or I'm, you know, maybe in my 40s and I'm now thinking, oh goodness, I need to go and get these insurances.
Yeah.
Let's say, I mean, the chances are the cost of it is probably going to be it's higher than, you know, what you get when you're younger, right? Is that decision point still the same in terms of, because obviously your timeline's smaller and so maybe the payback period is then going to be longer.
Yeah.
Right?
Exactly.
Yeah.
And that's why I think like what we would typically do when looking at those lump sum covers and deciding do you go like a stepped premium, a level premium, what type of sum insured, you need to essentially run a number of scenarios. You want to get quotes of multiple scenarios so that then you can kind of assess, okay, so for this scenario, my premium's going to be $150 a month, but that's the like full coverage scenario. And then you're like, okay, does $150 a month fit into our budget? Maybe it doesn't. Let's see how we would go financially with a half cover like scenario. And that's where I think, you know, looking at some of the pretty crappy resources online that try and help you determine how much insurance you need, my guidance around that to people, and this is what we can probably talk through, I guess, with your experience, is like, it's less about trying to figure out how much money do you want to leave to people and more about trying to work through the worst case scenario of if this event happened to me, what would my life look like?
Yeah.
And if I wasn't here, so in the event of a death, what would the life of those around me look like? And what do I need to think about for them?
Yeah.
Yeah. Because I think it's really easy for people to think like, oh, life cover, like you get that and you hold it when you're 60 and, you know, then you pass away and you have a nice gift for your grandchildren. But the reality is that people that really need that kind of cover are those that are in their 30s, 40s and 50s that have children that would be materially impacted as a family unit if one person was to pass away.
Yeah.
So,
Very true.
So grim.
It is a little bit, but it's, you know, shocking us awake. So I'm sure the listeners of the pod are like, are you listening?
Interestingly though, I mean, Christine, you guys do have life insurance and stuff now. So I'm interested to understand what was kind of the scenario thinking or conversation that you went through in order to determine how much life cover you and Ollie should have and whether or not you should even have it.
Yeah, great question. So, I mean, we got our policies in September last year, so we're definitely due for a review. And the driver of that, I think, was honestly probably just a conversation that we had, and we're like, oh, we should probably get some life insurance in place. Like we are kind of building our wealth to a point now where outside of owning a home, we've got a decent, you know, sum that we want to make sure also that we're considering. I mean, that's probably more will actually than his insurance, but anyway, all of it together. And so we reached out to an insurance broker that I kind of know through, I guess, what we do. And yeah, it was a good chat. Ultimately, we decided to get life insurance and trauma cover. And a big, I guess, a driver for that from memory, I think the logic was income protection is typically more expensive than the other ones. Is that correct? Or is that
if
not?
you ranked all four, trauma cover is typically more expensive, dollar for dollar, right? The reason where it caps out is most people don't get full cover for trauma. And what I mean by that is like if you actually tallied up, let's say like cancer, for example, if you actually calculated how much you likely needed for treatment if you needed severe treatment and you were going outside of the public system, you're needing in the realm of like hundreds of thousands of dollars.
Yeah.
And then also how much time are you going to have off work and what's the impact of that? Now, it's pretty, no insurance broker or advisor is going to recommend you go and take out like $500K of trauma because it's going to be so astronomically expensive. Yeah. So typically, like you see that they'll have a threshold amount that they advise up to and then potentially backfill that with income protection if they felt it was appropriate.
Yeah, right. Yeah.
Because if you had a trauma event, right, like let's say you had a stroke, you could be paid out immediately, lump sum for that stroke, the trauma balance, and then let's say you were then off work for 4 months, you would be paid out 3 months worth of your income protection if you had a 4-week waiting period.
Yeah, right.
So the money that and that's where it's like it's in the conversation, right? Because it's like, is your sum insured going towards treatment? Is your sum insured going towards your living expenses?
Yeah.
Like, what is that going to happen? Like talking through the scenario of, if Christine had a stroke, what is Ollie going to do?
Yeah.
Is he going to be able to work? Is he going to need time off? Are you both going to need time off from your jobs? Who's going to be caring for her? Do you have other family members that could step in to do that? Like, do you need to make alterations to your living situation?
Yeah.
Do you need money for treatment? Like, all those types of things is in the nuance of the conversation.
Yeah, I don't know if we went that deep, and maybe in hindsight we probably should. But I guess like a lot of the conversation was around the life stage that we're at right now in terms of we don't have any dependents, we don't have a mortgage, like, and so let's say if I was on the life insurance piece, if I was to pass away, then like Ollie really just needs to support himself through his income, right? And then also maybe he gets like a lump sum from me. The kind of cancer or trauma. So like, okay, I'll give you an overview of what we pay and what we landed on. So our policies with AIA, we have joint and survivor policy, I think.
Okay.
I think. We pay monthly $58, which is roughly $700 per year.
For both of your cover or is that for one? That's pretty cheap.
Yeah,
that's actually
cheap.
Exceptionally cheap.
Yeah.
I feel like you're underinsured. I'm just going to say that.
Well, looking at these songs.
This is why we need a review. Okay.
Yeah,
so fair. If it's a joint policy, I'd be very interested to understand that if you got paid out, because you guys have the same sums insured, if you got paid out for life and it got paid to Ollie, would he also then be paid out for his life? Or is it considered a joint policy, which therefore reduces the overall risk and the overall cost because they're only paying out for one person?
Great question. No idea. I will go
fantastic.
ask.
Okay, Christine will report back. She's got some
probably a good case study of like the average person just being like, I need something.
Knowing the deets.
So,
I mean, you guys are doing better than the average person. I need to give you that kudos.
Thank you. I think that honestly was kind of what we were like. We don't have anything right now outside of health insurance, so let's get something. And then, So I'm insured for $120,000 life insurance and then $200,000 in trauma. Ollie is $120,000 life and then $160,000 in trauma. And the reason for that was he has, so we both also have health insurance.
Okay.
And he has upweighted the cancer portion of the health insurance. And so he felt that he didn't need as much trauma cover because he had that as well. I know that there is like something in my health insurance that is around cancer. I just haven't upweighted it. And the reason for that is his mum is a cancer nurse. And so I think that for him is like the thing that he needs to make sure he's.
You should talk to him about the risk of cardiovascular events in males over the age of 40 and tell him that he has a window of opportunity to capitalize on a lower premium.
Now.
Ollie, it's more than just cancer. There's many events.
Other things, We also are covered for a few other things, which are final expenses, so around $35K, which is $10K of other costs, such as final medical bills, travel costs, $10K estate settlement, $15K funeral expenses, and then also repaying other debt. At the time, Ollie had a student loan. He doesn't have that anymore. I didn't have one. And then also ongoing income, it says that we're covered for. Fun fact. I didn't put the totals down, but it was basically 1 year of each of our salaries would like the other person would get that for a year to, I guess, get them back on their feet.
Yeah.
Okay. That's kind of where we're sitting.
Love that. I'm going to use you guys as an example of if you had come and chatted to Advisor Cat of a past life, what questions would I prompt you to think about? And
I'm going to write this down so for future me I remember.
You need these, but also so that the listener can figure out, okay, well, what are the scenarios that I need to think through, particularly pre-dependence, because there's a huge misconception that like if I have no dependents and I don't have a mortgage, I don't need any insurance, but you guys have insurance. So let's just call BS on that, because there are absolutely some scenarios that we've just talked through, like a heart attack or cancer, that would significantly affect your outcome financially if you didn't have cover. But we can also extend some of the questions to scenarios where you potentially do have a dependent or a mortgage. Now, first things first, when thinking about insurances.
Can I just say one thing?
Yes.
From what I read, we are also on stepped.
Okay.
Yeah. So that's
cool. Okay.
But,
so something to maybe consider if you were like, hey, could we just get a quote for all the same cover, but with a level premium? And could you send us through the little payback graph that the insurance companies do themselves? No work for the advisor. Send us through the little payback graph, and then we can figure out how long we would need to hold this policy for.
Yeah. And so I'm definitely going to be doing that. But I also think, just to give some context, from memory, the reasoning was potentially around it being like cheaper for us now. It is the cost conversation, and then when it starts to like step, maybe we fixed it at that point. But it makes a lot of sense of
so, exactly. Cool. So first things first with insurance and figuring out how much you need, you have to have a balance sheet, right? Because if you don't have a balance sheet, it makes any conversation really, really hard. You need to know what assets do you have and what assets does your partner have, so that you can figure out what money or assets you have at your disposal in various scenarios. The other thing is then to actually have a general understanding of your total cost of expenses as a household. So actually looking at like what it just costs you to run your household, not thinking about savings and investments and surplus, but just your pure costs. So the first thing, if we think about life cover, because in some ways it's actually the easiest, what you're essentially thinking about is, if I was to pass away and I didn't have any life cover, am I in the black or the red when I add up my assets versus any liabilities? So you mentioned like if you were to pass away, you don't have a student loan, you don't have a credit card, you guys don't currently have a mortgage, you've essentially got no debts that you need to pay off at all. And so you're in the black. Like you've got a pool of assets then, assuming you have some KiwiSaver, an investment account and some savings. And so there is a pot of money there to be distributed. Now, the second question from that is that pot of money big enough to be distributed in a way that I would be comfortable with if I was to pass away? Now, when you don't have dependents, it's relatively straightforward, because it's like, well, is Ollie super reliant on you and your income in order for him to be financially successful if you weren't here? If the answer to that is yes, then that pot of money that is left for him needs to be significantly larger. But if you felt like, actually, in a scenario where I was no longer here, Ollie's still going to be able to work. He's going to be sad for a period of time, and there's probably going to be a period of time that he wants to take off work, and we might want to factor that into our consideration so that he has some flexibility to basically grieve and not have the pressure to go and earn money. But really, if he's able to then return to work, is he going to be in a worse off scenario financially? Not really. So then when you look at like your current life sum insured, it's probably pretty reasonable, because if I don't want to like out all your numbers, but if I add your 120 to what's sort of in your KiwiSaver and investments and some other stuff, you're probably getting close to like 200, a bit above 200. That's a pretty nice like sum of money. Let's say Ollie got 100,000 and then you have a lovely niece. Maybe you want to leave a gift for her, like, and pay some funeral expenses and stuff. Like that's fairly straightforward. When it then extends to say like a Luke and my scenario and having kids and a mortgage, the questions you need to ask yourself just become the same, but a little bit more like wide. So, okay, if I was to pass away, what are the things that I would want to have happen so that Luke is not put under immediate pressure? Firstly, it would be very financially challenging for him to service our mortgage by himself and still have time to like look after Lily and those sorts of things. So the non-negotiable for me straight off the bat is I want to have enough money that can pay off our mortgage so he doesn't have the pressure of needing to like potentially leave our home. Because you have to think of it from the point of view of like, I want the least amount of disruption in a significantly traumatic event for my family. Yep. So for me, even though it seems extreme, I'm like, okay, I need to have on that balance sheet at least enough for our mortgage.
Yeah.
That's a done deal. I then need to think about what's going to happen with Luke and what's going to happen with our dependents. So right now we both work and we have childcare costs. So looking at, okay, he's not going to have to pay a mortgage because he's living in a house debt free, but is he going to be at a space where he can work full time? Are we guaranteeing that he's going to be able to work full time, or is he going to be in a space where he's trying to support his family and our child through a traumatic event and maybe wants to have the option to go part-time? So we're going to assume he drops to a part-time salary for a few years. Yep. So maybe we want to have another lump sum of, let's say his salary right now is 150K. We want to assume he can move to 50% of that for 2 years' time. So I want another 150K there just straight off the bat. So he has the choice. Yep. On top of that, I possibly want to, the next question is, were there things that Luke and I had planned together for the way in which we wanted Lily to experience life that they wouldn't be able to do if I wasn't around? Yep. So that's often where people think about like travel, types of schooling, university, based on the age, right? If we were super set on giving Lily a particular schooling experience that he was probably not going to be able to afford on one income, would I want to be insured for a lump sum amount that could basically ensure that goal? Yeah. So that's again kind of the conversations, right? Because the more stuff you add into the pot that person receives, the more expensive my premiums are going to get. And equally, those things will change over time. And that's why it's also a case of like, to your point, well, your numbers versus my numbers, like they're not the same because they entirely vary based on where you're at on a stage of life, but also kind of what your overall family goals are. So when we first went through this insurance process, Luke and I were insured for more than $2 million of life cover each, but we didn't have kids then. And it's just because we actually had quite a bit of debt. We had 2.5 properties. We were in a situation where we wanted to keep all of them and enable the other person to keep all of them without having any like financial impact. And so we were essentially just covering all the debt plus then a lump sum to give the grieving partner some time off work and time to be able to like sort through some stuff. Now, of course, that was quite a few years ago. So as things progress, our debt has reduced and our balance sheet and assets have increased as we've saved more in like business assets or shares or investment account. So that is now slightly different. But right now our lump sum insurance is $1.8 million each. Okay. So if I was to pass away, $1.8 million, like our mortgage is close to $1 million. So that's $1 million paid off our house, which basically means like Lily and Luke can stay there and not have the pressure of needing to make a stressful financial decision around that. And then there would be a lump sum of $800,000, which would basically kind of shore up their financial future and flexibility to move forward. It could cover things like Luke needing to get a full-time nanny, for example, because the other thing factor in like his job, he's not here all the time. Like those are the expenses that would need to be considered because he's not going to be able to go and get another job. And also you don't want your family member to have to be doing that in one of the most traumatic periods of their life. So you want to basically ensure that you have those things covered. Are we slightly overinsured? Potentially. But then I'm also just quite happy with the fact that it's not super expensive in terms of premium. And it's an insured amount that essentially gives our family like choice.
Nice.
So that's life cover. Was that a bit grim? Was it making you upset?
It's good. It makes sense. I think my questions are how much is the premium for that cover, on a weekly or monthly basis? And this is where I think it then comes into a good conversation. So the premium that we're paying for that, or that I pay for that life cover, I'm just trying to find this amount. I've just made this screen a little bit small. What is my premium? Payments. Let's have a look at the payments tab.
I'm assuming, Christine, you're like, what's the premium? Because we need to decide if we can afford it.
Yeah.
This is where I'm like, the scenario and the nuance in the scenario is what's most important. Because if I was my client and I was having that conversation with myself and I got to the point of being like, okay, I want $1.8 million.
Yeah.
I would probably be like, okay, we're going to get, and this is what we used to do. We're going to get a quote for the amount that you think you need.
Yeah.
And then we're going to get some quotes either side of that.
Yeah.
We're probably going to get a quote for that is just $1 million of debt.
Yeah.
Because that's kind of the bare minimum that we've agreed, right? So let's get a quote to see what that is, because that's your bare minimum price point that you have to buy into this with. Yeah. And then the 1.8, the premium for that is probably your upper limit.
Yeah.
And if the 1.8 is too hard in combination with the other insurances that you have, then we can flex somewhere in between there.
Yeah.
Yeah.
Yeah, nice.
And it's kind of like a horses for courses thing of like, okay, if 1.8 for life is ideally what you want, but actually that means that you guys can't get trauma insurance, but trauma insurance is the event that's actually most likely to happen in your life for both of you. Let's reduce the life cover so that then you have enough money to also get trauma cover.
Yeah, right. So yeah.
Because also, like, no one's going to choose having an amazing life for their family after they pass, but not being able to get through a stroke.
Yeah. Yeah.
You know, when you're both 40, for example. So I think that's where it's like, it's really helpful to have the conversation. And you obviously can have a conversation with an advisor, but as we're obviously very aware of, like, that is going to be very varied based on
who you get. Yeah.
Exactly. And part of this, I feel, can just be done if you're okay to have the conversation with your partner or someone else, right? Like, it is pretty grim, but like, even though we had this chat with an advisor, Luke and I have often subsequently had the chat of like, okay, we do just need to recheck in on like, if the worst case scenario happened, what do each of us need? What are we each expecting? Like, one conversation that we've also had when thinking about Luke's life cover is I've had to ask him like, what help would you like to be provided to your mum if you passed? Because his mum is a phenomenal person that has done a lot of non-monetary help for us and his sister in their lifetime. Yeah. And we would like to support her a little bit during retirement. So it's important for me to understand what his expectations of that would be, because that's potentially something that would also need to be built into a life cover policy, right? Yeah. Because if he was to die prematurely, then we would want to make sure that there's some ability for me to still like help care for her.
So Kat and I ended up chatting way longer than we expected to. So we've decided to break this episode into 2 episodes. Stay tuned for the second one being released later this week. Until then, don't forget to hit like and subscribe wherever you're tuning in, whether that's video on YouTube or listening on Spotify or Apple Podcasts. Otherwise, we will see you next episode.